Let me now bring on board Nilesh Shah, one of the smartest stock picker on Dalal Street. And just to give our viewers a background here, he identified Pantaloon at 40, Jacob at 200, and financial technologies at what price, Nilesh?
No comments, Nikunj, on individual stocks.
Double digit is what I remember in 2003.
Sorry?
Double digit is what I remember in 2003 for financial technologies.
Yeah, you're close to being accurate.
Okay. What's your market view now? Last time when I interacted with you, you were part of, not the bull camp, but you were part of the wait and watch camp.
Probably the view still remains the same. Clearly believe that you probably have another couple of quarters of single-digit earnings growth. And I think that's something which is not going to enthuse potential investors. Having said that, however, I clearly believe that these probably the next couple of quarters will mark virtually the low in terms of earnings growth. And I believe that post the correction in commodity prices and post the fears of monsoon, I clearly think that especially from say calendar year 2013, you would actually see earnings growth coming back into double digits. So I probably think that there's still some kind of consolidation which we still might experience for maybe a few days, few weeks, or maybe a few months. But post that, I probably think that you're beginning to see improvement in earnings growth.
Nilesh, morning. On the international front, though, after the Greece election outcome, which turned out to be as a relief, even though for a very temporary period, do you think all eyes now are on the US Fed and a QE3 is the next trigger which could actually, which could actually bump up global equities?
The expectations have started to come on in terms of QE3. Clearly, the market has started to building in a potential QE3, especially given the kind of economic data which has been coming out of the US. So I think in that context, a QE3 is quite likely possible. But that's something which will surely provide some up move to global equities and particularly to emerging market equities which have been underperforming. But I'd probably think that that's going to be terribly negative for India, which is basically a net importer of commodities. And I think if a QE3 would come, you might see a rally which would get on to a few sessions. But post that, I think a QE3 poses serious headwinds for an economy like India. So I think from an India point of view, purely from a very fundamental perspective, it would actually be good if a QE3 does not come in.
Nilesh, whichever way I cut and dissect, in this calendar year and in this financial year, Indian markets have been trapped in a range. The outer boundaries are 4,800 on the downside, 5,200 on the upside. When do you think we will snap out of this range?
I probably think that you need one kind of a downward move which breaks this market below 4,800. I probably think once you see that happening, and when by and large investors have given up, saying is that you're really going to now see extended periods of decline, I probably think that that's probably the time you would see a reversal. What could trigger that? My sense is that when market starts believing that you're going to have an improvement in a couple of quarters, I think that's really the time when you would see the markets again trying to come out of this range of 4,800 to 5,200. So my sense is that I don't think that situation is very far away. It probably is maybe 1 or 2 months away. But that's when I think the market will start beginning to see that era or a period of single-digit growth. We've been having single-digit earnings growth now for the last 4 financial years. Maybe FY13 could be the last year where we would actually see single-digit earnings growth. And I think that the next financial year onwards, you would actually see this market getting back into a double-digit earnings growth. And the markets will probably try and factor this or see this maybe 1 or 2 quarters in advance. So my sense is, I would think that probably it's going to not take more than say 2 to 3 months before the market starts to kind of break out of this range of 5,200 on the higher side.
Nilesh, if I look at all asset prices, equities, currencies, commodities, most of the asset prices have appreciated by about 4 to 6% from the May's law. How much of weight would you like to give to this price trend?
Well, I don't think it would be very important to really look at this price trend, because I think the up move which has come in is again on expectations that you're going to have another QE3, that the G20 will basically sort out a lot of issues. and that maybe Greece, etc., will not move out of the euro. I think that's basically the kind of expectations which is coming in. In addition to that, the expectations have been that a lot of central banks in emerging markets will cut rates. China did it, India did not do it. But I think from a very global perspective, it's essentially got to do with a lot of these macro monetary related issues rather than any uptick in earnings. So my sense is that I wouldn't attach too much importance to it. In addition to that, the markets did sell off heavily sometime in April, May. And I would probably think that what we've seen over the last few days, few weeks, is more got to do with short covering rather than any kind of change in perception about emerging fundamentals.
So what's been your portfolio strategy of late, Nilesh? Because market insiders are telling me that you've taken a strong cash call, which could be a contra call as well.
Well, we've basically not changed our strategy significantly. It's been like this now for a while. And I think what we've really been doing is to identify a value in companies where we see some really solid, robust growth. I think at this stage we're seeing a lot of positive developments, particularly happening in the infrastructure space. If you look at the kind of announcements which have been happening in the last 1 or 2 days, and which is really not some very solid developments at the national level, but if you really look at yesterday or day before yesterday, basically permissions have been given for 78 new skyscrapers in Mumbai. That's been pending now for a very, very long time. Permissions have been given. 31st July has been the deadline set for land acquisition for the Trans-Harbour Sea Link. And then, of course, I think there is now fair bit of expediency which is being demonstrated regarding the new airport in Mumbai. So I think if you really look at some of these micro developments, I think it gives us a lot of confidence, particularly in the infrastructure, the engineering space. And this is really a segment where we would really want to go ahead and take a contrarian call at some stage.
Did I hear you say infra, Nilesh? I mean, I'm just checking my ears when I talk back because no one likes infra.
Yeah, I know, and I think that's something which is the most hated. But if you really look at most infrastructure companies today, I think there is really no visibility of order book. There is therefore no visibility of revenues. And most of these infrastructure companies have a terribly leveraged balance sheet on which basically they have suffered quite a lot because of interest payments. And that's because of spike in interest rates. Somewhere down the line, I think the rate cut cycle is going to commence again. And two is that if the government really gets serious, I mean, I think they'll keep talking about FD and retail, FD and insurance, FD and pension, but that really does not help earnings at the micro level over a 1 to 2 year time frame. What is really going to help is basically the investment cycle picking in. And what I'm seeing after a very, very long time is that at the local level, at the regional level, at the state level, you're basically seeing the government get into an act, though of course in a tepid manner, in a slow manner, but I think it looks to be some kind of a sure start. The question is we've got to really wait for that action to kick in, but when that action kicks in, I think you're going to see a lot of value in some of these infrastructure stocks. Obviously within that you've got to have a bias for companies which are more capital efficient, who have a lighter balance sheet and have tremendous execution capabilities, and of course most important of all, really no governance issues.
Nilesh, you just talked about the RBI action. How soon can we actually see easing from the RBI, and could it be as soon as the next policy meet?
Well, it's quite possible it could happen around the next policy meet, or maybe it might get postponed to sometime in the middle of this financial year, which means probably sometime in October would be a fair time, because the RBI has already said that they have front-loaded the rate cut which they did in April. Our sense is that if there's nothing negative really happening on the global front, our sense is that maybe October would probably be the most appropriate time. However, if during this period between now and October, if there were to be basically some issues in the global arena, particularly in the Eurozone, then it's quite possible that the RBI has kept some ammunition. And if such an event were to happen, it's quite possible that the RBI may even prepone that. But I think October is a good time to really do that. Hopefully by that time, inflation would have come off. The RBI would have had a better handle in terms of growth and a better handle in terms of the monsoon and the impact of the monsoon on the overall economy. So I probably think that October would be really a good time to take a more informed decision.
Nilesh, You know, last time when I interacted with you on this forum, the acronym you gave me was SPACE. P for PSU, A for Agri, C for Consumer, and E for Engineering. What's the new acronym? Where are you investing?
Well, I don't think the acronym has changed, except that I think the P has kind of come off. So you could probably say that now we have a truncated ACE rather than a PACE, because I think really PSUs have really been lacking in terms of a lot of decision making. They've got hurt in terms of the sectors that they are present in. Again, there have been challenges out there. But I clearly think that from a India structural growth story, I think ACE, which is Agri, Consumer and Engineering, really summarizes it. On top of that, of course, if you get financials at the appropriate valuations, you could top up the portfolio with some bit of financials or specialized knowledge-based financial services players.
So it's FACE then, right? Okay, but you know, you just talked about financials, Nilesh. Don't you think NPAs would continue to be an overhang, at least for the PSU basket?
Absolutely, that's bang on. I clearly think that the PSU banking space is still avoidable. Most investors are basically believing that they're seeing value in PSU banks, but I still believe that taking that approach could land you in some kind of a value trap. And therefore, I think that PSU banks is probably still an avoid at this stage. Maybe a couple of quarters down the line, if they have basically put the asset quality behind them, and if the rate cycle in terms of cuts starts kicking in a more visible and a determined fashion, then maybe you could see a cyclical opportunity in PSU banking stocks. But otherwise, I still think that you've got to really identify quality banking and financial services players in the private space, where these players either have an edge in terms of knowledge or in terms of risk management, and have some room to grow in terms of their capital adequacy and the debt equity ratios.
Let me ask you a question which actually relates to your investment style. If a client walks up to you and his curiosity question is, look, I'm ready to take a 15% downside, I'm ready to take a 20% downside, but give me ideas which could be multi-baggers next 3 to 5 years.
Yeah, I still think that, the sectors that we discussed earlier, those are really the very obvious choices, which means, again, Agri, Consumer, Engineering, and the banking and financials. I think these are clearly the sectors to really focus on, and maybe just identify a couple of names in each one of them where you'd want to basically do an allocation between 8 to 10% of your capital in these kind of stocks, because I think at a 10 to 15% kind of a downside, and if you have a 5-year horizon, and these are companies which can still grow at about 20% plus, you potentially have multi-baggers in these areas.
Okay, so let's look at the A of your new ACE, Agri. How does one play and invest in Agri as a theme? Buy seed companies, buy fertilizer companies, buy irrigation companies?
I'd probably think that the agrochemical companies is probably the best place to be in, and then followed by fertilizers. I still think that in irrigation, the macro outlook is still very hazy in terms of subsidies and payments and cash flows, and there have been challenges which incumbents have faced in the irrigation space. So probably think that the agri chemicals and fertilizers as a space looks more promising. And within that, if you can actually identify players who are probably getting to be more integrated, which means that either are today significantly in agrochemicals and have a top-up of seeds, or are significantly in fertilizers and have a top-up in terms of either seeds or agrochemicals, I think somebody who's really building a nice basket, which would basically de-risk the company over a 3 to 5 year horizon, I think that's really the players to back.
Names, Nilesh, names.
No, I think the names are very, very obvious. I think these are names which we've discussed in the past, and I think a lot of these names have corrected. They've corrected by about 20 to 30% from their peaks, and I think if they were to correct another 10% from here, I think there'd be outstanding value there.
Nilesh, so would that basket continue to hold names like Hero, Motocorp, as well as Infosys, and are you bullish on their fundamental prospects on a long term?
Yes, I think both these are outstanding companies. They have demonstrated that the management quality is exceptional. They generate cash flows, and I think they clearly have both eyes on the risk parameters. So I clearly think both these are outstanding companies, and these are really the right segments to kind of be in. It's another matter that they could still have 1 or 2 quarters of sluggishness, But I think the valuations have become so attractive, particularly in the IT space, that at some stage you would really be tempted to take a contrarian call.
What is on your large cap watch list apart from Infosys and Hero Motocorp?
I probably think that for an institutional investor, for a large cap investor, I think a contrarian call on Reliance it could be worth it, and that's because I think there's been so much of negative news there, and the stock has been such a serious underperformer that if I believe that over a 2 to 3 year time frame, if the Indian markets are likely to kind of do well and bounce back, I wouldn't be surprised if a name like Reliance Industries ends up being an outperformer. I think in the next 2 or 3 years, they have multiple triggers firing, be it the retail business, be it basically the 4G business or the telecom business, or be it basically the possibility of an increased output from the gas side. I think all these are additional triggers which would basically improve operating profits. So I wouldn't be surprised if Reliance Industries ends up being an outperformer. I think those levels which we've seen in recent times of sub 700, I think represent a good value. You're basically looking at the stock at about 10 times, which I think is attractive for a stock like that.
You are negative on PSU banks, and you've clearly outlined why are you negative on PSU banks. But you like SBI, and you like SBI closer to 2000, closer to 1900?
Yeah, but again, I think that's more got to do with a call in terms of saying that, okay, if there would be a very clear-cut path to rate cuts, then obviously this is basically a stock which could do extremely well, given that the bank has again front-loaded a lot of their provisioning issues, have front-loaded a lot of their asset quality issues. And this is a bank which has always enjoyed premiums. I think in peak times, probably the stock was quoting at a valuation of close to 3 times adjusted book value, versus roughly about 1.5, 1.6 times currently. And I probably think that the long-term average has been probably around these levels or slightly higher levels. So you could actually see some kind of mean reversion happening with this stock. The day you clearly see a very clear-cut signal from the central bank saying is that rates have peaked out and you're going to basically see rate cuts happening in a more aggressive fashion.
Nilesh, final question. No tricks here. Clear and a straightforward question. If you have to construct a portfolio of large cap stocks, maybe 3 or 4 large cap stocks, which could give a CAGR return of 15 to 20% return for next 3 to 5 years, what would you buy in that large cap portfolio?
I think it's pretty simple. I think names like Reliance, Infosys, ICICI Bank, I think these are some of the names which I think would really qualify in that, because I think again in all these stocks which I mentioned, I think they have been serious underperformers, and valuations have turned very attractive, and they have exemplary management. So I think a basket of these kind of stocks would perfectly fit in a portfolio like that.
And if you have to throw in, let's say, just one mid cap, 4 large cap, 1 mid cap, what is that mid cap?
No, sorry, I think I'd probably not specifically name, but look, I think in terms of a space, what I think is that the consumer space, we've seen huge price corrections in terms of the discretionary spending related sectors, not the very obvious personal care sector and things of that kind, but I think stocks which have got to do with fashion, consumer durables and things of that kind, which is about discretionary spending. My sense is that you've seen a fair bit of price erosion, and that's really the segment to watch out for.